Hey everyone, it's Hamish Hodder here and welcome back to another video. Today we're doing, as the title says, Q&A for the month of March 2019. We're back again. Thank you to everyone who submitted a question below the post of the last video, February's Q&A video, and also people who left a comment below my post on the community board of my channel. So those are the two places that you can leave a question if you're looking to leave a question for the month of April, next month's video. So if you have a question, leave it down below this video or comment it on that post when I make it, which will be in about a month's time. But yeah, we're just going to go through some of your questions, go through one by one and answer them all. So let's get into it and let's get into the first question. All right, so the first question we've got here is, hi Hamish, can you please do a segment on government bonds in Australia, the different types, how they work, their advantages, disadvantages against shares and stocks, or shares or stocks? Yes, I do plan on making a video covering government bonds for US or Australia in the near future. I do plan on doing that because it is an area of investing that I think a lot of people don't know too much about, and you're not too exposed to it unless you've gone out of your way to do in-depth research. So I do plan on doing that. But in terms of how they work, it's just a way for you to earn a pretty much guaranteed return. So you can lend, essentially what you're doing is you're lending your money to the Australian or the US government, and the chance that they don't pay you back is very, very slim, especially when it comes to the Australian or the US government. They've never not paid a government bond back. So it's what's considered in the investing in the finance community as a risk-free investment. So whatever return you can get on that bond, say for example, on the 10-year US Treasury at the moment, it's about 2.7%, I believe, and the Australian 10-year is about 2.2%. So if you buy that bond, from the US or Australian Treasury, then you're guaranteed to make that yield per year for the next 10 years. But essentially, you really just always want to have cash doing something. If you have a significant amount of cash or even any amount of cash, it's better that it's earning at least a little bit of a return than earning nothing. And this might mean if you have a lot of cash, then this might mean putting some money into a long-term bond, like a 10-year bond or a 10-year term deposit or a 5-year term deposit, something where your money is locked away for a long period of time. But then of course, with the rest of your cash, you can also just put it in a place where it's not locked away, but it's still earning you a return. So maybe you can go into a high interest savings account for the money that you want to keep available in case stocks go on sale. And that could earn you 1 to 2% just by having it in a high interest long-term savings account. So the main point of government bonds is you don't really need to go to government bonds, but you should have your cash earning something. And that means that you should definitely go out of your way and research some high interest savings accounts, term deposits and bonds in order to find where you can put your money so that it earns a little bit while we wait for stocks to come on sale. And then when stocks come on sale, we can use that money, that cash, in order to buy cheap investments. The next question we've got here is from Rainbow Investing. How long until your research platform goes live? Very excited. Oh, it's great to hear that you're excited. I'm very excited as well. Not long at all. We're thinking probably a couple of weeks it should be able to be released. A lot of the content has been created and it's going to be an ongoing content creation. So I'm just trying to build up as much content sort of backlog as I can so that when it goes live, I can start to release that every 2 weeks. And of course, there will be content on the platform when it launches. So we're thinking probably a couple of weeks. Probably towards, I'm not sure when this video is going to go out, but probably towards the end of March and the first couple of weeks in April is where it's likely to go live. But I'll be sure to let everyone know when it does go live. And I'll actually leave a link to the waiting list down below if you want it. You just put in your email and then I'll send you an email when it goes live. And you actually also get a 30% off coupon if you do that. So go ahead and do that if you're really interested. But yeah, a couple of weeks, not long, and it should be a really good thing. The next question we've got is from Hugo, and he asks, I understand the power of compounding and how you can build wealth over time, but I don't understand how stocks compound your money. Maybe you can explain that a little bit more. All right, so the easiest way you can think of this is just think of the business behind the stock that you're buying as a savings account. If you have a savings account that's earning you, say, 2% interest, then if you put money into that, over the next year, you're going to earn $2 back. If you put in 100, you're going to earn 2% back. Now, if you leave that $2 in there, then in the next year, you're not going to earn $2 of interest. You're going to earn the $2 of interest on the 100, but then you're also going to earn a little bit of interest on the interest that you left in there. So instead of earning interest on $100, you're now earning interest on $102. And over time, if you keep leaving the interest in there, it's going to compound rather than you just putting 100 in, taking the 2 interest out, and then getting another 2, taking the 2 out and getting another 2. If you leave it in there, it will compound over time. So you just need to think of a business in the exact same way. A business has cash within it, and it uses some of that cash to make investments. And those investments generate a profit, which is your interest in the bank account, savings account analogy. So they generate profit, and what they do is they put some of that profit back into the business and reinvest it. And what that means is in the next year, they don't generate the same profit, they generate more profit. And then they can take that larger pile of profit and put it back into the business and make more internal investments and generate even more cash flows. And the result is that over time, the value of the business grows. And the result of that is that there's going to be a compounding effect in the growth of the stock price. So just think of it like a savings account. If the business leaves some of its profits in the business, like you leaving the interest in the savings account, then when you earn that return over the next year, it's going to be bigger and compound over the long term. The next question we've got here is from Eric, and he asks, "Hey Hamish, I watched the CNBC interview with Warren Buffett, and at around 1930 in the video, he discusses how they overpaid for Kraft. He estimates that they overpaid about 100 billion for tangible, or they paid 100 billion for tangible assets of about 7 billion. My question to you is that on top of your other metrics, how much are you willing to pay for a company's tangible assets, or is there a better metric to ensure that you don't overpay?" Okay, so the price that you pay over their tangible assets is essentially the premium that you're willing to forego now in order to receive those future cash flows. So it's what you're willing to let go now in order to receive the cash that this business is going to generate over the next 10 years. So like, if you could think of a really, really simple business that has $100 of cash within the business, and that's it. If you bought that business for $100, then you essentially paid nothing, because you pay 100 for the business, you own the whole business, and then in theory, you could just take the 100 that you got with the business and put it in your pocket, and you'd be back where you started. And that $100 of cash within that business, in that example, is essentially the same thing as tangible assets. So if you bought a company, except the difference is that if you buy a company, not only are you buying the tangible assets, you're also buying the future cash flows that business can generate. So for that reason, you're actually willing to pay more than the cash or the assets within the business, because you're willing to forego a little bit, maybe it's $100, because over the next 10 years, the company is going to produce $400 in cash for you. So the premium that you pay is simply what you're willing to forego now for those future cash flows. And when Buffett says that he overpaid, it means that he overestimated how much cash he could get back from Kraft over the next 10 years. So an example of overpaying might be that you pay $100 for the business, and over the next 10 years, it returns you 50. So that's not a good outcome, because you paid 100 and 10 years later, you're still down $50. Another example might be if you pay 100 and over the next 10 years, it returns you $100. Yes, you got your money back, but you kind of just broke even. There's nothing too rewarding there. What you would want to do is you want to find businesses that you can buy them very, very cheap. So you pay $100 and they bring you back $300, $400, $500 in cash over the next 10 years. And in those circumstances, if you're just very, very conservative, if you only pay a very small amount for the future cash that could come into the business, then you're either going to make an okay return, meaning that you pay 100 and maybe they bring back 150 or 200 over the next 10 years, or you're going to pay 100 and they perform really, really well, and you're going to bring back $300, $400 per year, and you're going to 4 times your initial investment. But the key essentially to not overpaying is to be conservative with those future cash flows. So you might think that a company has the ability to produce $300, $400, $500 in cash, But if you're being conservative and realistic and you look at the market and you think, okay, maybe if they underperform and they sell this many units instead of this many units and their market share shrinks by this much instead of maintaining or growing, then how much cash are they going to produce? Then maybe it's, 200, 250. And that would mean that even if you paid 100, you'd still make a decent return. And if they perform really, really well over the next 10 years as you initially expected, then you're going to make a massive return. The next question we've got here is from Bradley, and he asks, how often do you make trades or buy and sell within a year? Long-term horizon, meaning pros and cons of trading less or more frequently. So I don't really have a set amount of trades that I make each year. I don't go out and say I'm going to make this many trades. The amount of trades that I make really just depends on the valuation of the businesses. If there's businesses that I like, that are really strong businesses, they have great moats and they have great management, and their price is very low relative to how much cash I can conservatively get back over the next 10 years, then I might make a lot of trades in order to invest in those companies. And also on the flip side, if the price of a business that I like, a few businesses that I like, and their prices are really high relative to the cash that we can get back, then I might be looking to sell them and pick up their shares later when they're a little bit lower. So for example, in 2018, at the very start of the year, I reevaluated a lot of my investments and I found that a lot of them were quite expensive relative to their cash flows. So I sold a bunch of them. I probably made 5 to 10 trades. However, this year, for the first 3 months of this year, I haven't made a single trade. So it really depends on what the valuation of my stocks are doing and whether or not I can find something that I like, or whether or not they're too expensive, and whether or not it's somewhere in the middle. The main pro of this method is that there's just not many costs. I don't trade in and out of stocks, so I don't have to worry about those costs. The other thing is capital gains tax. I'm not sure about in the US, but in Australia, if you buy and sell an asset within the first 12 months of holding it, then you pay capital gains tax on the entire investment, which means if you're short-term trading, then you're paying more capital gains tax. However, if you hold an investment for more than 12 months, you only pay capital gains on 50%. There's a 50% discount. So that's another pro. But I guess a lot of people would say that by selling my shares when they're expensive and only buying them when they're cheap, and by not trading in and out of stocks in the short term, a lot of people would say that I'm missing out on the potential to make profit there. But that's just not the game that I play. I treat businesses as what they are. They're businesses that generate cash flow over the long term. And for that reason, I don't treat them like they're just a little price that moves up and down. I treat them as what they are, and I hold them for the long term, and I see the cash flows that those businesses generate over many years, not to just try and make a profit from the price movement between what someone is willing to pay last month and what someone is willing to pay this month. The next question here is from Sean. Hey Sean, you have a great channel. Go check out Sean's channel if you haven't seen it already. But his question is thoughts on hedging your portfolio with copper, lithium, gold, etc. And also thoughts on investing in emerging markets. So yes, I think that those two areas are areas that I will eventually go to, because of course it's good to diversify into different markets and to have a little bit of experience in one set of area. You only want to invest in what you know, but you also want to know different areas so that you can be diversified through those areas. And essentially, in order to get really good at investing in a particular area, you need to concentrate a lot of your time in it. And that's what I've been doing for the past few years. I've concentrated my time and my effort and my research in learning about US and Australian businesses and learning about specific industries within that, such as the RV industry. And for that reason, I haven't looked elsewhere, but as I build my knowledge in those areas and I become very confident in those areas, I will then look to emerging markets and I will look to diversify through miners, and I will concentrate my research there and learn everything about it. But really the key here is to invest within your circle of competence. And those areas at the current moment are way outside my circle of competence. I have no idea how to assess the cash flows of a gold miner or a lithium miner. And I really don't know anything about emerging markets companies. So for that reason, I'm just sticking to what I know right now, but I will be expanding my knowledge into those areas so that I can have a bit more diversity in my portfolio over the long term. The next question we've got here is from Ahmed, who asks, "Hi Hamish, can you give us your thoughts on terminal value and its methods?" All right, so terminal value, for those who don't know, it's where you're estimating the combined total cash flows that a business could produce, say, beyond 10 years. So beyond where you could accurately estimate. So what I do is we invest in, we calculate what the future cash flows could be for the next 10 years, because I think that's a reasonable sort of range where you could estimate. In the very short term, say 1 to 3 years, I think it's difficult because you don't know what is going to happen. Over the 10 years, you've got an entire business cycle, sometimes 2 business cycles, and therefore you can find out what is the average amount of earnings or cash flow that a business could produce, and therefore you can average that over the 10 years and come to a fairly reasonable estimation. So I've found that looking 10 years out is the best estimate. But what a lot of analysts will do in their models is they'll estimate the first 10 years or the first 5 years, and then they'll use what's called a terminal value, which is essentially what you could get for the company after that period ends. For me personally, I don't really use it, and there's really a couple of reasons why. The first reason is that as I said, I don't think it's reasonable to expect that you can calculate cash flow beyond 10 years. I think that's really difficult, and you really need a very stable business that isn't going to change for, say, 50 years in order for you to be confident in estimating 20 years of cash flows or 30 years of cash flows. And the second reason is that, or it's pretty much the same as the other reason, is that there's not many businesses that stay very much the same for more than 10 years. Industries change quickly, even industries that are very, very old and have been around for a very long time. Things change, consumer preferences change, technology develops, especially in the technology age that we're in, that we've had, especially in the past 20 years with the internet. All businesses are changing, and there's always new businesses coming in with new technology that the old businesses didn't have and taking over market share. So I don't try and calculate what's going to happen with a business beyond 10 years. I leave that, I basically assume in my models that you get nothing after 10 years. And by doing that, I'm simply being conservative. I don't really think that a company that produces 10% returns on their investments after 10 years is just going to disappear and you're going to get nothing from them. I don't think that's true, but I don't know what they're going to produce beyond 10 years. So it means that I'm not going to calculate it at all. I just assume that you can get back the book value that you initially got when you bought the investment, and that's about it. And by doing that, it means that I avoid making massive assumptions about companies in the future, and it allows me to avoid making really critical errors and making really poor returns over the long term. I just find really great businesses, and every now and then, occasionally, maybe it's every 5 years or even longer, one of them or a couple of them will go on heavy discount because they have a short-term problem that is going to last for maybe a year. And when that happens, I invest heavily and I can see massive returns. Not only will I make massive returns in terms of the cash flows that I've estimated for the next 10 years, I will also probably make money on whatever I can sell the company for or whatever cash flows the company produces beyond 10 years. But in terms of calculating it, I don't try and do that. And the last question we've got here is from ASX Investments, and they ask, what's the difference between depreciation and maintenance capital expenditure? So depreciation is just an accounting expense. It's just something that appears on paper, and it's not in any way related to how much cash a business actually spends to maintain their assets. So depreciation is supposed to show the sort of the loss of value in an asset that a company has. So you might have a tractor or a piece of machinery, and depreciation writes down that the value of that on the books, depending on it, and it's supposed to represent, when it gets to zero, they have to buy a new tractor or another piece of machinery. It's supposed to represent how much money they're spending each year in order to maintain that asset. However, as I said, it's got nothing to do with how much cash they're actually spending. But if we then have a look at maintenance capital expenditure, that number is actually how much cash they're spending to repair these machinery and to buy new machinery. And that number is a real number. It's how much cash they're actually spending. So often, it doesn't happen often, but what companies can do is they can lower their depreciation charge, which means their profit on their income statement looks bigger than how much they actually generated in cash. So this is why I always look at the cash flow statement in combination with the income statement, because the income statement can sometimes have these little accounting tricks that can make it look like a company is more profitable than they actually are in terms of how much cash they're bringing in and how much cash they're letting out. So that's all for the Q&As for March 2019. If you do have a question for next month's video, make sure you leave it down below or leave it on the post that I will be making in about a month's time. Thanks everyone for watching. And if you're new around here, of course, hit subscribe and hit that notification bell so you don't miss out on any of the future notifications. But for now, guys, I'll see you in the next one.